Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 9, the exercises, Group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Right, so we're working on problem 9-35, and I believe that, and just quickly glancing at this, I'll be able to do 35 and 36. So let me get my pen here, and it says, Orthopedic Medical borrowed $2.1 million on July 1st by issuing a 9% long-term note payable that must be paid in 3 equal annual installments plus interest each July 1st for the next 3 years. Okay, so we're classifying notes payable as current or long-term here. And so insert the appropriate amounts to show how orthopedic would report its current and long-term liabilities. Okay, so we have 3 years, and over the 3 years, the current portion is going to be the same, right? So it's 2.1 million, and we divide it by 3, okay? And that gives us $700,000 a year, all right? So our current portion is going to be 700,000 for each one of these, for each year. Oops, sorry about this. Oh, there we go. 700,000. Okay, so our current portion of the long-term note payable is 700,000 for each year. Now, let me erase this. Okay, so then we're going to calculate the interest payable. All right, and the interest payable is at 9%. Right, so in our first year, we have 2.1 million. Okay, at 9%. Right, and it's from July 1st, so that's 6 periods, 6 months divided by 12. And if we do the math, we end up with $94,500. So our interest payable for 2014. Remember, if we look at a timeline here, okay, this is July 1st, okay, we're looking at this 2014, so that's on 12/31, right? That is a 6-month period, right? So we take the 2.1 million times the 9% interest times 6/12, which gives us an interest payment at, at the end of the year, which gives us an interest payment of $94,500. Right? Which now our long-term note payable, right, is 2.1 million less the current portion of 700,000 gives us 1.4 million, right? So 1.4 million is the long-term portion of the note payable. Okay, so that's for 2014. Now, again, we figured out that it's for 2015 that the current portion is 700,000, but our interest payable is not. We have to consider how much interest we're paying on what we still owe, and it's 1.4 million this time, times the same 9%, times the same number of periods, 6/12. And when you do that math, you end up with $63,000. Okay. So our interest is $63,000, right? But now the long-term note payable since we've paid off 2014, we're looking at 2.4 million is the amount of the payable, but 700,000 is the current portion, right? So our long-term portion is the 700,000, right? And so that's for 2015. Now we move over to 2016, okay, and we have for our, we still have the 700,000 as our current portion, all right? Our interest payable is 700,000 because that's what we owe at the end of 2015 times 9% times the same 6 months, and that gives us an amount of $31,500, right? And of course, at the end of the year, if we only have a $700,000 note and the current portion is 700,000, right? And the current portion is 700, right? Our balance is 0, so we have no long term. And that's all there is to it for that particular exercise. And if you didn't understand that, go back and watch it again. It's just purely mechanics here, okay? And what is needed to know is, what you need to know is the idea of when I have a long term, like especially on the liability side of the balance sheet, when you have long-term liabilities, you separate out the current portion. And when you separate out that current portion, okay, that gives you the net amount for the long-term portion, right? Now they're showing it in this fashion here, but just as a quick example, if I have a $360,000 mortgage, so mortgage payable, so that's long-term, and let's say that is for let's see here, 12 years, I know, 10 years, 12 years, 1,000 times 12, right? Well, let me do it like this. $1,000 a month times 12 is $12,000 a year. And so that's for 30 years, so that's 360,000. There we go, 360,000. When we're showing it on our balance sheet, okay, we will show the current portion of the mortgage payable of $12,000 in our current liabilities, right? Down here in the long-term liabilities, it's going to show as the mortgage payable of 360,000, but you're going to have less the current portion of the mortgage payable as a description. Oops, I'm running out of space here, so let me erase that. So that's going to be the 360,000 less the 12,000, which you put up here, right? And then that's going to give you the book value of 348,000 as the actual long-term portion of the mortgage payable. All right. So when you're looking at the balance sheet, you're able to see that the mortgage payable is actually 360. You can see that the current portion of that mortgage payable is 12,000, and you can also see that the long-term portion is 348,000. Okay. All right. So with that said, let's look at the next one. I think we can get through that. Actually, no, I'm going to stop because I'm at 9 minutes and pick up in the next video. So if you didn't understand any of this here theory, which you should by now, okay, because this is relatively easy, go back and watch the theory videos, and if you still don't understand it, feel free to contact an instructor.